Someone on social media just told you that rental properties are the path to passive income. They are not lying, but they are only showing you the highlight reel. They are not showing you the vacancy month, the 3 a.m. plumbing call, and they are definitely not showing you the math after the mortgage, the property taxes, the insurance, and the maintenance. Here is the rental property math that never makes it into the reel. On a $300,000 property with a typical mortgage, when you subtract property tax, insurance, 1 month of vacancy per year, and 1% of the property value in annual maintenance, the numbers often barely break even. And that is before your time, before the calls, before the repairs. There is a structure that collects real estate income from apartment buildings, warehouses, data centers, hospitals, without requiring you to own a single property or answer a single call. And there is one number in 2026 that has made the rental property math even harder to run and made the ETF case easier to win. I will show you that number before this video ends. The blueprint starts now. This video is for 2 types of investors. First, you have been watching rental property content and the math or the lifestyle has not added up. Second, you already own VOO and SCHD from the Investomistic Portfolio series, and you want the real estate layer that completes the income architecture. Either way, by the end of this video, you will understand how to earn real estate income without the operational overhead of direct ownership. And here is the number that has changed the rental property calculation in 2026. The 30-year fixed mortgage rate currently sits at approximately 6.37% per the Freddie Mac Weekly Primary Mortgage Market Survey. At 3%, the rental property numbers were strained. At 6.37%, the monthly payment on a $300,000 purchase has risen by hundreds of dollars, compressing already thin margins to the point where most rental properties cannot cash flow positively in the first several years. The ETF structure collects the same rental income stream, without the mortgage, without the 6.37%. Subscribe now, because next Thursday I am covering the one tax detail about REIT ETFs that every article recommends without mentioning, and it changes which account you hold these in significantly. That blueprint drops Thursday. Subscribe so you catch it. A REIT, a real estate investment trust, is a company that owns income-producing properties. It collects rent from its tenants. By law, it must distribute at least 90% of its taxable income to shareholders every year. That legal requirement is why REIT yields are higher than most dividend stocks. The structure forces the income out. It cannot be retained in the business the way a tech company retains earnings. The 10-year Treasury yield sits at 4.38% as of this filming. That matters for REITs because higher long-term rates raise the discount rate on future rental income and increase REITs' borrowing costs. REITs struggled from 2022 to 2024 as rates spiked. But here is the 2026 reality. Rates have stabilized. VNQ is up approximately 9.72% year-to-date, without a single rate cut. Rate stabilization was enough. You do not need falling rates for REITs to generate income and appreciate. Before the 3-fund blueprint, quick check. Drop it in the comments right now. Landlord, if you own or plan to own rental property. REIT, if you prefer the ETF structure. Both, if you are building both sides of the real estate income equation. One word. I read every one, and your answer shapes the next blueprint. VNQ, the Vanguard Real Estate ETF, is the largest REIT fund available to retail investors at approximately $69.6 billion in assets. At 0.13% annually, it costs $13 per $10,000 invested per year. Current yield, 4.19%, distributed quarterly. Year-to-date in 2026, 9.72%. Trailing 12 months, 12.70%. Inside VNQ: apartment complexes, industrial warehouses, data centers powering AI infrastructure, hospital real estate, self-storage, retail. The honest picture. VNQ's top 10 holdings account for approximately 53% of the fund, concentration risk that can increase single-name exposure. VNQ also holds a small number of real estate operating companies that are not structured as REITs. And because it pays quarterly, not monthly, not weekly, income arrives 4 times per year. For investors who want the broadest possible real estate exposure at low cost, VNQ is the natural starting point. SCHUTZ, the Schwab US REIT ETF, is the precision instrument. At 0.07% annually, it is the lowest cost REIT ETF available, $7 per $10,000 versus VNQ's $13. It tracks the Dow Jones Equity All REIT Capped Index and holds over 120 securities. The critical architectural decision: SCHUTZ excludes mortgage REITs entirely. What remains is a portfolio of companies that directly own and operate physical properties. The fee difference between 0.07% and 0.13% sounds trivial. Over a $50,000 investment compounding at 7% annually for 30 years, the difference is approximately $3,000 in fees that stay working for you rather than going to the fund manager. For cost-conscious investors who want clean equity REIT exposure without mortgage REIT complexity, SCHUTZ is the more precise instrument. Trade-off: slightly lower yield than VNQ because the mortgage REIT income is excluded. USRT, the iShares Core US REIT ETF, is the third option and the one most investors overlook. It tracks the FTSEN REIT Equity REIT's 40 Act Capped Index, holding 131 companies at 0.08% expense ratio. The key distinction? Slightly more exposure to mid-size and smaller REITs than VNQ, which reduces top 10 concentration risk. Over the past 10 years, USRT has outperformed VNQ on an annualized basis, 5.93% versus 5.49%. That 0.44 percentage point annual gap, compounded over a decade, is a meaningful difference. Year-to-date in 2026, USRT is up 5.24%, trailing VNQ's 9.72%, because the 2026 REIT recovery was led by the mega-cap names VNQ overweights. USRT is the choice for the investor who wants consistent, low-cost equity REIT exposure with slightly less large-cap concentration. Here is the number I told you about in the hook. The 30-year fixed mortgage rate in 2026 sits at approximately 6.37%. At 3%, a landlord with a $300,000 property could plausibly cash flow positively after all expenses. At 6.37%, the monthly payment alone has risen by hundreds of dollars on the same property, compressing margins that were already thin to near zero or negative for most purchase scenarios. The rental property math that social media sold at 3% does not work the same way at 6.37%. Here is the honest comparison. Rental property offers things REIT ETFs cannot: direct leverage through a mortgage, depreciation benefits, control over the asset. These are real advantages. What rental property cannot offer at 6.37%: positive cash flow in most markets without a substantial down payment, immediate liquidity, fractional entry, and zero management burden. REIT ETFs do not replace rental property. They replace the rental property dream, the version social media sold at 3% rates, which no longer exists at 6.37%. Here is the tax psych frame. Social media is selling you the landlord life, the real, the passive income, the freedom, at interest rates that no longer exist. What it is not showing you is the 6.37% mortgage rate, the $300 monthly property tax, the vacancy month, or the 3 a.m. call. The REIT blueprint is not a lesser version of rental property investing. It is a different mechanism, one that collects the same rental income from the same properties without the operational overhead or the debt service at 6.37%. You now understand something most social media real estate influencers will never tell you, because they need you to believe the only path is through them. The properties exist. The tenants exist. The rent exists. You just collect your share of it without showing up, without a mortgage, and without a call at 3 a.m. The pattern was here the whole time.